Let's focus in on a management voice, find out the capital raising plans as well as asset quality concerns and business outlook for Indian Overseas Bank. Mr. M. Narendra, Chairman and Managing Director, now joins in on the show. Mr. Narendra, thanks very much for being with us. To start off with, walk us through your capital needs over the next 2 years and what is the capital infusion that you expect from the government?
Yeah, see, we had already received the letter from the government that they are actively considering our capital requirement, and they had asked us to be ready with all other arrangements. We expect that earlier at the 20% we had requested for 1,500 crores. Now that the credit growth has been slightly moderated, but within our requirement to reach 8% above, we are getting the capital. That indication of certainty has been already received by the government to us. Then as far as the future is concerned, the Basel II to Basel III, our position is comfortable. The first 2 years, the requirement altogether may be another 2,500 crores. Only on the third year onwards, the requirements increases. So with full 5 years of Basel II to Basel III implementation, the requirement of capital may be relating to around 10,500 crores, which I think over a period of time with the payback of the profits and all other available opportunity of qualified institutional placement or private placement or as well as the right issue, we will be able to cover.
With the banking bill being passed, will IOB be looking at raising capital via the rights issue or bonus issue or QIP for that matter over FY14? See,
of course, we had earlier in the June, in the annual general body meeting, we have taken all the enabling provisions to go whenever opportunity for right issue or the preferential share issue or qualified institutional placement or private placement. However, this particular, what is the likely quantum that goes on changing as and when our what you call plowback of profits and all the available opportunity that changes. So currently we are also government level there is a thinking. We had one type of discussion other day, that is in the FM meeting, that in the event of government infusing capital, the bank can also look at option of right issue. However, that firming up that view has not been done up to now.
Your margins were also under pressure. How do you see your margins for the third and fourth quarter shaping up in FY13?
Yeah, you are right that, see, one is that we are really getting little more very competitive rate we give to the productive sectors. So from the lending point of view, we are not unreasonably charging high rate. But from the deposit point, cost of deposit can be reduced now that the rate of interest on deposit started moderating. So we followed the policy of shedding the bulk deposit. So in the third quarter, some improvement of margin, limited extent, has already taken place. So we feel that our endeavor of 2.75 to 2.85, we would like to see it covering back by March or maybe by June. It will definitely come. There, mainly because quite a lot of bulk deposits are maturing in the January, February, March, and which will get repriced at the lower rate. So we are seeing the margin improvement coming through, except that the current account is not really getting in, but the savings are growing. So I think with the twin method of rationalizing the deposit cost and also giving competitive rate to the productive sectors and all, we will be able to regain the margin.
Right, Mr. Narendra, your asset quality has deteriorated. In Q2, if I look at the sequential difference, your asset quality has deteriorated by about 500 bips. How do you see your gross NPA and net NPA levels, moving for rest of the year?
That is, you are right that we brought down the asset, NPA level substantially in the last 2 years by substantial recovery. But the last 2 quarters, some of the bigger account as well as some of the medium segment and maybe limited in the SME and agriculture has gone into the incremental NPA. However, the other side of that, we are now aggressive in recovery. My recovery, which first 2 quarters I have done, I have already crossed that by double. Means suppose it was 400, now we have crossed already 800 crores of recovery. So I feel that the NPA level has little going to be moderated in the third and fourth quarter. So with the result, Of course, the overall credit growth has been little lower. So the figure of gross NPA to NPA your credit NPA, your NPA level, we are talking on the aggregate level. We would like to bring down from the current level in the next 4 quarters. We will be able to bring, but by March also there will be a substantial reduction by way of recovery.
And Mr. Narendra, how has the third quarter been in terms of your slippages, and what's the outlook over FY13 and 14?
Yeah, you are right. Now it is very difficult to predict what will be the slippage, but one thing is the peak level has been in September, but as far as the certain sectors still having difficulty, now we have an indication from the macro aspect, October, November, December, the production and all have been increasing. So if that results in better economic climate and industrial production, the slippage will be definitely coming down. So from that point of view, what NPA we had in the first 2 quarters, the next 2 quarters will be lower. That much I can indicate. Now as far as the 2013-14, I feel that we will have a very better period, and the economy also will recover. Our NPA level also will come down, and the current level of our growth is maybe 18% of credit growth and maybe around 18 to 20% of resource growth. The next year will be slightly better than that.
How has the additions to restructured assets been so far, and what is your outlook for FY13 and then for FY14?
The restructured asset per se is in our bank has been very good, in the sense 97% of the restructured assets are performing. As against the industry 18-20% default, our default has been only 8%. So that part of that restructure. Another thing is quite a lot of the restructured assets have already completed more than 3 years. In the event of the RBI permitting us to shift it to the normalcy, most of the majority of the restructured assets will come down. But at the moment we feel that from the restructure angle is slightly limited, but there are some pipeline cases. But as we have projected in the full year, the CDR cases will be around 6,500 we have projected, and of course one big account also has already opted, which are in the industry, for restructure in CDR. So that part of that we will have to take into account. So overall the restructure amount may be slightly from the current level of around 14,000 may go up to another maybe 2 to 3,500 crores provided, but I am not really sure as on date but it is as per our earlier projected figure.
And finally, what is a big concern for most of the analysts is your exposure to Suzlon. Could you tell us what it exactly stands at and what is the status on this account?
We don't normally tell about the individual party. So we are the Suzlon is currently, because it is available in the website of the CDR, they have already filed for CDR. Now the necessary further workings are done by the SBI. So we are also one of the banker along with the other major 4 or 5 banks. So we may be in 4th or 5th position, and that once that package is approved, they will be. There is no other separate any FCCB issues are all here. It is primarily related to their RE power. They are getting the what you call ring fencing removed, so that they will get a higher cash flow within all the banks. So that is under the examination by the State Bank of India.
And finally, what are your targets for credit and deposit growth over the next 2 years?
Yeah, we will be, this year maybe around 16 to 18% is the credit growth, because the Reserve Bank has projected 16, we may be another 18%. And as far as the next year, I am sure it will be more than 20%, because we are now focusing on retail credit, we are focusing more on agriculture and micro and small sector, and also in the mid segment in terms of the working capital and other expansion. And the next year definitely the investment activity will come up, more projects will be in the offing, and similarly the incremental working capital. So we expect better credit growth in the next year.